The date is March 2020. Inside a federal building in Washington, Treasury officials sit around a polished wooden table, reviewing numbers that dwarf the budgets of most nations. $1.6 trillion, then $1.7 trillion. Outside that building, a 22-year-old graduate refreshes her bank app. Her first payment is due in 3 weeks. She owes $38,000. The interest clock is already ticking. Inside, policymakers debate stimulus, deferment, and forbearance. On trading desks across New York, analysts model cash flows from student loan-backed securities. In suburban offices, loan servicers process millions of monthly payments with industrial efficiency. One obligation, 3 perspectives, one number that connects them all. How did a program designed to make college affordable evolve into $1.7 trillion Australian dollars financial machine? How did debt intended as a bridge to opportunity become one of the largest asset classes in modern finance? This is not a story about reckless students or greedy lenders. It is the story of a system constructed over decades where risk was redistributed, incentives were reshaped, and education quietly transformed into collateral. President Lyndon B. Johnson signs the Higher Education Act. The setting is Texas State University. The goal is explicit: expand access to college for middle and lower income Americans. At the time, college enrollment is limited. Banks are reluctant to lend to 18-year-olds with no income, no assets, and no credit history. From a lender's perspective, a student loan looks like unsecured risk. There is no house to repossess, no car to tow. The federal government solves this with a simple intervention. It guarantees the loans. Under the original federal Family Education Loan Program, private banks issue loans. If the borrower defaults, the government reimburses the lender. The promise is elegant. Students gain access to capital. Banks earn predictable returns. The government expands education without directly funding every dollar. Think of it as a co-signed loan, except the co-signer is the United States Treasury. The mechanics are straightforward. A bank lends $10,000 to a student. The student agrees to repay with interest. If repayment fails, federal guarantees protect the bank from most losses. Risk shifts from private balance sheets to taxpayers. Initially, the system functions as intended. College enrollment expands dramatically through the 1970s and 1980s. Higher education becomes a pathway to middle-class stability. The model seems rational. Education is human capital. Loans are investment capital. The borrower invests in themselves, repays from higher income later. But embedded in that logic is a powerful assumption: that college costs remain stable and earnings continue to rise. The propagation and the hidden flaw: by the 1990s, something subtle shifts. Tuition begins rising faster than inflation. Public universities increase fees as state funding declines. Private institutions expand amenities, facilities, and administrative staff. Easy credit alters behavior. When students can borrow more, colleges can charge more. This dynamic mirrors housing markets before 2008. Abundant financing increases purchasing power, which increases prices. At the same time, Wall Street discovers that student loans are not just debts. They are assets. Here is the mechanism diagram, the plumbing of the system. Step 1. A lender originates thousands of student loans. Step 2. Instead of holding those loans for decades, the lender bundles them together into a pool. Step 3. That pool is sold to investors as a student loan asset-backed security, or SLABS. An asset-backed security is not complex magic. It is a bond backed by a stream of payments. Imagine 10,000 borrowers making monthly payments. Those payments flow into a trust. Investors purchase slices of that trust and receive portions of the cash flow. If mortgages can be securitized, so can student loans. Securitization changes incentives. When lenders can sell loans quickly, they no longer bear long-term risk. Their focus shifts from credit quality to loan volume. The originate-to-distribute model, famously criticized in the subprime mortgage crisis, takes root here as well. Sallie Mae, originally chartered by Congress in 1972 as the Student Loan Marketing Association, its purpose is to create liquidity in the student loan market. Over time, it transitions into a private, shareholder-driven corporation. Profit becomes central. By the early 2000s, student loan-backed securities are a recognized asset class. Pension funds and insurance companies purchase them for steady yields. Rating agencies assign high grades, citing government guarantees and historically low default rates. Student loans are uniquely difficult to discharge in bankruptcy. Unlike credit card debt or medical bills, federal student loans cannot simply be wiped away. The Bankruptcy Reform Act of 1978 and later amendments in 2005 make discharge extremely rare. From an investor's standpoint, this is powerful protection. Borrowers cannot easily escape. But from a systemic standpoint, it creates rigidity. Debt becomes inescapable. Defaults do not eliminate obligations. They merely suspend payments or trigger wage garnishment and tax refund seizures. The central paradox emerges. The tool designed to expand opportunity begins to constrain mobility. Loans intended to increase lifetime earnings instead weigh on household formation, home buying, and entrepreneurship. As balances grow, so does reliance on income-driven repayment plans, deferments, and forbearances. The debt does not disappear. It compounds. By 2010, the federal government makes another pivotal shift. Through the Healthcare and Education Reconciliation Act, it ends most private bank-originated federal loans and moves to direct lending. The Department of Education becomes the primary lender. The government is now not just the guarantor, but the creditor. Outstanding balances accelerate. Tuition continues to rise. Enrollment expands further during the Great Recession. As unemployed workers return to school, the machine scales.